Okay, this is the financial focus portion of our meeting. And if you haven't already, if you're just joining us on YouTube, maybe for the first time or listening to the podcast, and there's no way to like it. I think you can like a podcast, but if you can, go ahead and like that. You can certainly follow it and you can subscribe to the podcast, but certainly on YouTube, if you haven't already, hit the like, subscribe, and notification buttons. This way, whenever we release new videos, and we release them often, then you'll get notification. And today in this financial focus, we're going to talk about Roth conversions and annuities. So very, very simply, I'm going to share my whiteboard here. I'm going to first talk about Roth conversions. So we just got to go back to the basics a little bit. I'm going to go over here. So remember, you've got three different categories for your investments. So we have, you can think of them as buckets. We have taxable, tax deferred, and tax-free. So we're going to focus on these two right here. And tax deferred, for most of us, that's IRAs, traditional retirement plans like 401ks. And then tax-free is Roth and anything, some properly structured cash value life insurance. But today we're talking about Roth. So a popular and very powerful strategy, and we talked about it, quite a bit in preceding this in our weekly webinar, is what's called a Roth conversion. And that simply means that you're allowed to take money out of this bucket here and move it over to here. That's a distribution coming from your traditional IRA and a redeposit into your Roth IRA, and that's referred to as conversion. And the cost of that is the tax rate, right? So you pay your tax rate. So if you think the taxes are going to be higher in the future, then it may make sense for you to consider a Roth conversion. So very, very common strategy. So that's what a Roth conversion is. And you should go, if you have an interest in Roth conversions and you don't know this, you should listen to the weekly webinar portion of this if you haven't joined us from that. And we talk about some details around Roth conversions, or we got a lot of different videos about conversions. But those are the basics of Roth conversions. Now let's talk about annuities. So there are many different types of annuities, and we've talked about that previously as well. But there are some benefits and trade-offs with annuities, and they're complex in structure because of these benefits, frankly. But many of them have some kind of market protection, and many of them have guaranteed future income. And one of the things I didn't add here was many of them have, they all have some form of death benefit. So again, annuities can be cumbersome and not helpful to your plan, or very powerful in your plan, depending how they're structured. But you've got to know your benefits, costs, and limitations, because there are few annuity companies that will allow you to effectively schedule Roth conversions over time. Now, when we think about categories, and if you're thinking about using an annuity, and just say your primary objective for your annuity is to have some level of guaranteed lifetime income for you or for you and your spouse, you have to ask yourself, where would you like that income to come from? Well, for most people, that would be this tax-free bucket, right? You want that to be Roth. So whether it doesn't, it's just like a mutual fund in this way or any other investment. The annuity is an investment on its own, and it has some tax consideration on its own. But if you own an annuity as an investment in the traditional IRA, you're going to pay tax on distributions when you take those distributions. If you own an annuity in a Roth IRA, any distributions have zero tax. Now, of course, you have to meet 5-year rules and things like that when you're talking about Roth distributions. But let's assume you've done that, and your annuity is these are qualified distributions, and you're paying zero tax. So if you had a choice to receive guaranteed lifetime income, for example, where would you want that income to come from? Would you want it to be taxed, or would you want it not to be taxed? Well, for most people, they'd want it not to be taxed. So a common strategy is because most people have most of their money in this tax-deferred bucket right here, a common strategy is we'll allocate a portion of the investments within the tax-deferred bucket inside of an annuity. We like the ones that offer principal protection, guaranteed lifetime income, and, of course, a death benefit. You've again, got to be careful of the costs and nature of it. But we'll allocate a portion of the holdings into an annuity and have a schedule to convert part of that annuity over time, because most people don't take $1 million, for example. Let's just say you have $1 million in this tax deferred bucket. Most people just don't convert that all at once over to Roth and pay a huge tax bill on the way. Most people say, okay, well, here's my $1 million. What if we convert it over time? And it's different for everybody. It might be 5 years, it might be 7 years, it might be 10 years. It depends on your situation. But here's where you've got to be careful, because there are some annuity companies, and I only know of 4 right now, that will say, hey, that's fine. If you have, let's just say $500,000 of your investments in an annuity, we'll allow you to transfer that over time. No problem. And we'll continue the same guarantees you have, continue the same start date that you have, and that can work quite well if that works for you. There are other companies. So we have a client that we took on this year that had a annuity already in their IRA. And let's just use the same example. And they had a $500,000 value, and they're receiving, or they can receive distributions based on a $600,000 value, because there can be some benefits that offer a higher value for income than their current value. So maybe I should talk about that. Let me step back for a second and talk about some basics around that. So when we talk about the potential benefit of using an annuity, so let's go over here. If we think about it this way, we have a current value or contract value of the annuity. So let's use that same value, $500,000. So just like a mutual fund, just like a stock or a bond or an ETF or something like that, it will have a current value. With a mutual fund, stock, bond, or an ETF, that current value is going to be, what you draw from. So if you want to draw income off of that, you figure out the income that you need off of that, and then you need $25,000, for example. That's drawn off of your $500,000. What annuities offer is as the annuity is growing, they offer a difference between the current value and I'm going to call it an income value. So every annuity company calls it something different, but I'm going to call this an income value. And I'm just going to refer to it as IV. Sometimes it's future income value, sometimes it's protected income value, but we're just going to refer to it as income value. So you might have an immediate value or a value that grows over time of, say, $600,000. So now you have a difference. So obviously the difference here is $100,000. Well, that in a couple of years that could be $650,000. Then it could grow to $700,000, and the different. Now you might be saying, well, heck, the mutual fund can also do that. If that was a mutual fund, that can grow over time as well. The difference with the annuities is these values typically are locked in. Once you hit that guaranteed value, then it can't go below that for future purposes. And of course that's the benefit, because a mutual fund. So now let's go over here and let's talk about a mutual fund as an example. A mutual fund or an ETF or a traditional investment, let's just say. Well, sure, that could start at $500,000 and that could grow to $700,000, and then we get a market correction, and it could correct back to $600,000. Where an annuity, once depending on the structure of the annuity, of course, once you hit these levels, $600,000, $650,000, $700,000, as long as you follow the rules of distribution in the annuity, if the market crashes back down, you're going to be locked in at $700,000, for example. So you won't go below that $700,000 for your income value, or potentially even your death benefit, depending on how the contract is structured. So you'll see that there could be a value between the actual cash value of the investment, just like there's a value with the mutual fund, and this income value. Let's just now call it $700,000. So now the difference is $200,000. So this is where you have to be careful when you're converting, when you're considering placing funds from your tax deferred bucket in an annuity, because one of the questions you want to ask is, can I convert these funds, right? So number one is, can I convert? Can I move this from the traditional IRA to a Roth IRA? Now, the representative on the phone or the person sitting across the desk from you might say yes. But sometimes they say yes, and the but is sometimes it's, well, yeah, but you got to do it all at once. And that might not be what you want to do. So that $600,000 $500,000 cash value, you may not want to convert that entire thing. They may also say yes, but if you convert, you give up the guarantees. Now that one is very common, and that's the situation we have with a few clients. We didn't place these people, and we didn't recommend these annuities that they have. They have them already, but let's just say they have a $500,000 value, the existing value, current value, and their income value in this case, or even death benefit. That's a D. Death benefit is $700,000. The annuity company might say, yeah, you can convert it, but now this $700,000 income value and death benefit goes away completely, and what you have left is the $500,000, and we're happy to put that in a Roth IRA for you. Well, that's problematic for a couple of reasons. First of all, you may be counting on that income, you may be drawing on that income, and you likely paid for that income somewhere along the way. There are few companies that don't attach fees to these income differences. So these are the things you have to pay attention to. I hope that makes sense. I hope that gives you some good background on that. So now, if you choose to convert a portion of your annuity, if it makes sense, if it's allowable and it continues the guarantees, because there are just now 4 companies that I know that will in fact allow you to say, okay, we've got a $500,000 value, we've got $700,000 in future value, whether it's income value or death benefit. Now we want to convert a portion of it. So the $500,000 goes from traditional IRA to Roth IRA. So traditional IRA to Roth IRA, and but we do it over time. So let's just say 5 years. 1, 2, 3, 4, 5 years. So $100,000 a year. So what will happen there is it'll capture not only the $500,000, but also the difference in the guarantee. So when you're done, your entire $500,000 plus any growth you have along the way, will be now in your Roth bucket as opposed to your traditional IRA bucket, right? So tax advantaged or tax-free and tax deferred. Now that $500,000 plus growth and your $700,000 of future value, whether it's income value or death benefit, plus any growth, right, will reside in Roth. So that's the best way to handle it, right? So everything carries over, the guarantees carry over. We're not worried about blowing anything up, like all of a sudden we have to give this away, give away what we've earned and potentially paid for. And we also don't have a situation where we have to do one massive Roth conversion if that doesn't make sense to you, for you. But now there are ways to convert it over, but the devil's in the details. You got to have the right company for your purposes. And like I said, today there are only 4. I'm not going to name them because this is about education, not about, individual advice. So you got to be careful. You got to know your benefits, costs, and limitations. Pay attention to reduced or no Roth conversion options, elimination of benefits. And we want the proper placement. So the proper placement, I believe, let's go back to this. If we're talking about guaranteed lifetime income, if we're talking about tax efficient growth, where do you want those investments to lie? You want them to be in the tax-free, tax-advantaged side of the ledger, right? So any guaranteed income, lifetime income, ideally you want to be at zero tax there. So this is number one best place for your annuities to live is the tax-advantaged or tax-free side. Number two would be the tax-deferred side. Sure, there is a potential that guaranteed income, if other income is low enough, that guaranteed income that comes out of the annuity, distributions of the annuity, could also be low tax or tax-free, depending on how much is left in there and your standard deduction and your other income. So certainly that may be an option for you. And many people start with that annuity in the tax-deferred bucket and, like I said, convert it to Roth. Hardly ever do we want money in this taxable bucket, the annuities to be in the taxable bucket, because if your journey is a tax efficient journey, if you think taxes are going to be higher in the future, if this annuity grows, let's use that same $500,000 with a $700,000 future value, and that continues to grow. When you take distributions, you're going to be taxed, right? There's going to be a tax rate assigned to that. And that's going to be forever. Annuities are very, very tax inefficient outside of IRAs and tax advantaged accounts like Roth IRAs. Any growth has to first be paid as ordinary income tax. You don't get capital gains treatments. You don't get anything like that. And that tax rate is going to be applied on all distributions until you go back to your original amount that you put into it. And then what the big question is, what's that tax rate going to be? What is that tax rate going to be? And if you think taxes are going to be higher in the future and you're doing all this work to convert your money to Roth IRA, but you have this annuity in your taxable bucket and you're taking distributions from there, I always use the analogy of it's like pouring a fire hose into a leaking boat that you're trying to bail out. So ideally, we don't want annuities in this taxable bucket. We want them in the tax deferred or the tax advantage bucket. I hope that's all readable. I'm just taking a second to look at my board. So number one here, I'll just do it again. Number one here, number two here. I wouldn't even assign that a 3. Let's stay with the X. And if you have annuities already in that taxable bucket, there are ways to unwind that. We can, let's just go. You can contact us at questions@attleboroughwealth.com. That's questions@attleboroughwealth.com. So all is not lost there. It's just makes things more difficult. But now let's just say we have this conversion strategy, and we want to take a portion of this $500,000 and convert it every year over the next X number of years. Well, that sounds easy and it makes sense, but annuities are complex vehicles, so there are different calculations to be used. So we know that, let's use our example, a $500,000 annuity may have a future value of $700,000. So will the IRS allow you to convert that entire $500,000 and only pay tax on that $500,000 and not the $700,000? Well, the answer is no, right? You have to pay tax on the actuarial present value. It's called this APV, and these are complex formulas. I'm going to share a little bit of the where it comes from and the regulations, the tax regulations, and I'm going to show basically how it's calculated loosely and theoretically how it's calculated. But there's a couple things to pay attention to, and you should be aware. So you have what's called a fair market value and actuarial present value. So if you think about it, the IRS is keen on this. They say, well, wait a minute. You or someone else, your heirs are going to have a benefit of this $700,000, whether you take it as lifetime income distributions or whether it passes to your heirs via death benefit. So we're not going to let you pay tax just on that $500,000 when there's a future benefit of a much greater amount. But we're also not going to make you pay tax on that $700,000. It's somewhere in the middle there, and actually tends to be more to the left of the middle there. So let me share with you what the heck I'm talking about. So here's some excerpts from the tax regulations, so you can see here where it's coming from. And it reads, converting amounts to Roth IRAs. So what is the amount that is treated as a distribution for purposes of determining income inclusion when conversion involves an annuity contract? So I'll just read this to you. Notwithstanding the section, that's subsection 1.4084E, when part of all the traditional IRA that is an individual retirement annuity described in this section, or 408B, is converted to a Roth IRA for purposes of determining the amount includable in gross income as a distribution under another section, 1.408A4A7, the amount that is treated as distributed is the fair market value of the annuity contract on the date the annuity contract is converted. Similarly, when a traditional IRA that has an individual retirement account described in Section 408A holds an annuity contract as an account asset, and the traditional IRA is converted to a Roth IRA for purposes of determining the amount includable in gross income as distribution under subsection 1.408A4A7, the amount that is treated as distributed with respect to the annuity contract is the fair market value of the annuity contract on the date that the annuity contract is distributed or treated as distributed from the traditional IRA. So that's a very technical way of kind of saying what I just said. But let's do, this is a Q&A that I pulled off of a particular annuity company's website, and I tried to snip it so that it didn't refer to that company, and I hope I was successful. So the first question is, why is fair market value important? The answer is fair market value for IRAs is reported to the IRS annually in IRS Form 5498 for IRAs and is used to determine the required minimum distribution amount necessary to satisfy mandatory distribution rules outlined by the IRS. So that refers to RMDs, and fair market value is important in that regard. Fair market value is also used to determine the taxable amount of the direct Roth IRA conversion, partial or full, from a traditional SEP or simple IRA annuity to a Roth IRA annuity. In general, next question. In general, how is the fair market value calculated for deferred annuity contracts? Fair market value, let me make this just a slight bit larger. Fair market value is calculated by taking the contract accumulation value as of a specified date, for example, December 31st, plus the actuarial present value of any additional benefits. The APV of an annuity must be determined using reasonable actuarial assumptions without regard to the individual's health. So if you want to get technical, you can pull up this. Or actually, I'll put this link in the description for this section here. But you can pull up this link and you can read what the reasonable actuarial assumptions are. So how the APV is determined. Answer: each annuity company is responsible for using reasonable assumptions to assign an APV of the benefits offered under its contracts. Our calculation takes into account many factors, including age and the value of any income benefits, as well as death benefit provisions. Regulations clearly indicate that certain types of death benefits must be assigned a value. Most commentators agree that the regulations presumably also apply to certain lifetime benefits and contract value guarantees. Again, these income values and death benefits are contractually guaranteed, these minimum guarantees. So there is a value that has to be calculated when we're doing Roth conversions. It's not something that may happen. Somebody might say, well, geez, if I had a mutual fund or an ETF and I convert it, that same $500,000 or $100,000, and that could grow over time. Yeah, but that's not a guarantee. The contracts have some level of minimum guarantee, and that is what's used for that calculation. You could convert a mutual fund today or an ETF or a stock, and it could lose value tomorrow. But the IRS realizes and knows that these annuity contracts have some level of minimum guarantee that's going to benefit someone. The IRS and the Treasury Department believe that it is generally appropriate to reflect the value of additional benefits under an annuity contract, just as the fair market value of all assets generally must be reflected in value in an account balance under a defined contribution plan. So let me give you an example. I know that's very confusing, so I'm going to give you an example. And you don't have to calculate this, by the way. The annuity company calculates this, but I'm going to give you an example of a recent conversion that we did and what this looks like. So here is the snapshot of the confirmation we received. So your tax reporting information. It reads, a partial Roth IRA conversion results in a taxable event will be reported as required. So we didn't convert the entire annuity holding. We did a portion of it. And this tells us that the IRS Form 1099-R for the 2024 tax year will reflect the taxable amount of, in this case, this is just an example. This is not specific to you. This is just an example for education. It'll reflect the taxable amount of $270,999.24. 1099-Rs are mailed no later than January 31st of the following year. IRS 5498 for the 2024 tax year will reflect a converted amount of $270,999.24. 5498s are mailed no later than May 31st of the following year. So what does that mean? Remember, we have $270,999.24, which is our 1099-R converted amount that you're going to pay tax on in this example. Taxed amount. But if we look at the now accumulation value of that conversion, it's $255,906. So this shows us really, really well. So I'm going to put this on a kind of a line here. So we have contract value. You can't see it. Okay, contract value or current value, 200. And this example refers to it as accumulation value. So again, that's 255,906, 33. In this case, they call this future income value or income value. This company calls it protected income value. That protected income value, the contractually guaranteed protected income value, so that'll be for future income withdrawals or death benefits. Well, and so we're going to call this income value and even death benefit. And in this case, they call it a PIV, protected income value. That is at $314,345. So this person wanted to convert. It made sense for them to convert $270,000, right, or $271,000 in this case. So their conversion amount is the 270. So that's 1099 amount. And that's going to be your fair market value based on your actuarially present value. That falls in at $270,999.24 in this case. So you'll see that the amount that you're taxed on the conversion isn't your current value or your account value or accumulation value. And it's not your future guaranteed value. It's somewhere in the middle and to the left of the middle. Now, some people I've had this discussion where people say, well, that doesn't seem fair. I converted I only converted $250,000 and I'm paying tax on $270,000. I think it's actually very fair because you have a future value of this $314,000 in this example, and you're only paying tax on that future value of on the $270,000. Because it is, it's not even in the middle, and it's certainly not $314,000. I know it's not $255,000, but it's also the rules. These are the rules and that we have to follow when we're doing Roth conversions. And again, you don't have to calculate this. The annuity company will calculate for you. Now, the thing that you want to pay attention to though is when we have, let's recreate our buckets in the time we have left. Let's recreate our buckets. So we have taxable, tax deferred, and tax advantaged. And let's say we have $1 million in tax deferred and 500,000 of it is in that annuity. As we work on this schedule, well, we're going to want to convert that whole $1.5 million. But we're going to front load the annuity, right? So these first few years are going to be annuity conversions, however long it takes to get those out. The reason being is that this gap for most contracts will widen. The difference between the account value and the protected income value, it starts depending on the company. So here we have current value, accumulation value is here, and then the protected income value or future income value or death benefit, is here, right? So that's the difference between the two. But as your years go by, this typically widens because we get some growth here, but the multiple is much greater typically on these income values and death benefits. So hopefully we have some good growth or decent growth on the annuity side. These spreads will widen over time, and therefore your fair market value and accumulation value, actuarial present value will also increase. And so this difference will widen, and you'll end up paying more tax as it goes, as compared to the account value. So I hope that makes sense. So that's one reason why we like to escalate these conversions in these Roth IRAs, because we want to minimize the amount of tax that you pay. The other reason is we want that tax-free income to come out as soon as possible for you. So it makes sense to do that. Now, the caveat to that is that, remember, the most annuities, certainly the annuities that we deal with, are principal protected. So if the annuity is invested in the S&P 500, or it follows the movement of the S&P 500, let me say, and you've got your $500,000 sitting here, and the S&P 500 ends up being down 20%, the worst that your principal protected annuity is going to do is 0% growth, right? So zero, you won't go anywhere below $500,000 unless you have some kind of fee associated with your annuity. But you might have other investments that are significantly down. So the reason we may shift from converting your annuities early on to shifting and going back to this other $1 million, where the heck is my bucket? Other $1 million you have in your regular investments outside of the annuity is because we have an opportunity to move funds from traditional IRA to Roth IRA that now have fallen because of the market. So we know we'll see a recovery in that at some point, as long as they're sound investments. So we might change in, let's say, this year and say, okay, we're not going to do the conversion in the annuity this year. We're going to take it from the regular investment account, and we're going to move our $200,000 over from the investment account, because now that $200,000 can recover. So it's not an absolute. We do like to move these annuity dollars sooner than later because of that widening of the spread, but there are times that we do it differently. Okay. Whew. All right. That's a lot. Just like anything, it seems like I set out and I say, okay, this is what I think we should talk about this week. And I feel like it's simple in my head. And then when we start drawing it out, it becomes more complex. And that certainly is one of them. But I hope that was helpful. This is a complex situation. This is complex information. I hope I break it down so it's somewhat understandable. And I do have, So I was just told ads popped up 3 times overriding your presentation today. I had to click skip ad to get back to your presentation. Never had that happen before while viewing your weekly presentation. Well, I don't know, Keith. I'll have to check on that. I've never had that either. Hopefully you can see the whole thing in the recording, or I'll see how I can turn off those ads for you. I think rather than getting 6 cents from YouTube, I'd rather have you see the whole presentation. But thank you for that. Paul says only once for me. I hope they were good ads. And if you need to, you can go back and look at the recording, because, again, this is important information, I think. Folks, this was, I hope you enjoyed this. I hope it was helpful. We'll see you next week. I think we have, I didn't mention this, but I think we have Thomas Byelich on next week, who leads our investment committee. And that if that's the case, I'm going to let you know. But if that's the case, that will be a client-only webinar. So it may just be for our dear clients, because we'll talk about some details around investment management and our specific portfolios, and we don't share those with the general public. But I'll let you know, and you'll receive your notification. All right. Have a good week and take care. Bye-bye.